Hello, World Economic News for Wednesday. We've seen this chart before, but it pays to look at it again. It's private sector credit as a percentage of GDP, which just keeps growing. That's the black line going bottom left to top right. About 200% in 1980, but up to 370 something percent now abouts. And the Fed funds target rate, which was 20% in 1980, Paul Volcker trying to rescue the dollar, and it's come down and down. The savings and loan crisis made it go down. It tried to get up. LTCM, long-term capital management, pushed it down. Then the tech crash pushed it down. Subprime bubble, credit crunch, general malaise now has got it on the ground, and it's been there for 3 years. It's easy to say it can only go up. It doesn't have to. It can stay there, like it has in Japan for the last long time. Real GDP, year-over-year percentage growth. Again, United States. It was a lot wilder in the old days. This goes back to 1947. You can see it was wild, big ups and downs, but vaguely up to the 1980s, I think you can see that the average was about 5%. And from 1980 to 2001, it was 4%, something like that. But from 2001 up to the present day, it's been 2%. It's coming down and down and down. So there's no reason that little hook at the end won't go down again. And if it does go down, the Fed funds rate will stay down. It's all down. Which path to financial independence? Now, this is sourced from the California Association of Realtors, the Dow Jones Industrial Index in jolly green, or the median home price of a Californian residence in red. Going back to 1980, how to make money. Don't buy a house in California, bung it in the stock market for the Dow Jones. This is The Economist that regularly prints this house prices across the world and has under and overvalued. Latest Q1, but more interesting, the middle column, 2006 to 2011 prices, how much they've gone up or gone down through this crisis. Hong Kong's up nearly 100% through the crisis, but leaving it overvalued at 64. It's a number, 64 overvalued. Singapore's up 2/3 but overvalued. France is up only 10%. but is well overvalued. That's mainly Paris. Belgium, Switzerland, we get to Britain in just below the middle, and it hasn't gone up or down, if that's what nil means, but is very overvalued at 28 blips. It could even mean 28% overvalued, not quite sure. United States slightly lower, has gone down 13%, and is still only a little bit overvalued. Japan's a bit strange. It's gone down 12 and it's greatly undervalued. Poor Ireland at the bottom, it's gone down 35%, but still is overvalued by over 20%. This chart is the European banks. It's a special way of just all the banks in Europe, well, the main banks in Europe, out to the stocks 500, and these are the banks going back to 2009, well, 2008, when it was really bad. You can see it's crawled up from where it was in that Lehman Brothers collapse type time, and it got itself up. But you can see the general trend, especially lately over the last 3-4 months, has been down and down. The market, in its infinite genius, has spotted that there might be problems in the European banks, as they've got that level back down to the level it was at the time of Lehman crashing. FTCom Alphaville gives us China pressure points. After the weekend's Chinese data, indicating both slowing imports and rising inflation, came this on Tuesday from Beijing. China's foreign exchange reserves rose 30% year on year to hit 3.2 trillion US dollars. $3.2 trillion. The people's government's money, and that's the people's money. That's the people of China's money. Another place the people of China's money has gone into is investment, building fast trains and cities in the middle of nowhere and all sorts of skyscrapers. The people can't afford to buy these houses, even to buy tickets on the high-speed rail, but their money is all invested in it. 48% of GDP is in investment, and that is very high. To give you an idea, this chart I dragged from somewhere else that's China being dark. Now it looks like they're saying it's up to 54% for China, but around the 50% mark anyway. And a couple of places in Africa are wildly high like that. But generally the Western world, lightest at 8, but the Western world is normally between 10 and 20. Vast differences. So what we have here is the Chinese government investing, or the Chinese people's government investing the Chinese people's money in all sorts of things, like government bonds of United States of America and Europe, and high-speed rail and things. But one day the people will want their money back, and we'll have to hope that the Chinese people's government have invested it wisely. Finish with this: strong correlation between rising incomes in China and India and the gold price from 2000 to 2010. It's not, you can't say it's exactly why the price of gold's gone up, but it's an interesting sort of correlation that get the scales right and they go up like brothers walking off into the sunset together. That's it. See you tomorrow for Thursday. Bye.